Hey everyone, welcome back to Corporate Decoded, the place where we, decode corporations. Today we're diving into nVent Electric's latest annual report. It's a long one, packed with numbers and legal jargon, but don't worry, we'll break it down, and trust me, even though it's about electrical systems, it's not going to be shocking, or is it? Okay, so nVent Electric, what do they do? Think of them as the folks who protect and connect critical electrical stuff. They make enclosures to keep sensitive equipment safe, and they also provide the connections that keep the power flowing. They're not just selling wires and boxes, they're selling peace of mind for important systems all over the world. Big news in the past year, they bought a company called ECM Industries, which cost them $1.1 billion, a huge chunk of change. ECM makes electrical connectors and tools. Also Tracti, a company that makes control buildings, they paid almost $688 million for Tracti. So why these purchases? nVent is betting big on being a one-stop shop for protecting and connecting electrical systems. They're organized into two main businesses, enclosures and electrical and fastening solutions. Think of enclosures as the box business protecting systems and data. Electrical and fastening solutions is about connecting power. Now, in early 2025, expect a name change. Enclosures is becoming systems protection, and electrical and fastening solutions is becoming electrical connections. Speaking of competition, nVent faces a lot of it. Some companies compete on price, others on local knowledge. nVent's success hinges on being reliable, innovative, and having good relationships with distributors. One thing to keep in mind, their business tends to pick up during the spring and summer months, at least for the electrical side of things, like a spring cleaning effect. Let's talk about orders. Their backlog, or the amount of orders they haven't fulfilled yet, jumped up a whopping 62% to almost $750 million. That's mostly thanks to buying Tracti. They think most of those orders will be shipped in the coming year. Like any company, nVent faces risks. Global economic slowdowns, competition, and keeping up with technology are all concerns. Inflation is a big one, driving up costs for materials and labor. Also, with operations all over the world, they have to deal with political and trade uncertainties, which could affect their ability to make and distribute products. Cybersecurity is a major concern for any company these days, and nVent is no different. They rely on computers and networks to run their business, making them a target for attacks. They have programs in place, but there's always a risk. Now, for some numbers in 2024, nVent's net sales were just over $3 billion, an increase from $2.7 billion the previous year. Operating income, which is like their profit from core operations, also went up. However, net interest expense jumped significantly thanks to taking on more debt to buy Tracti. Also, their income tax bill was significantly higher than the previous year. All this resulted in a decrease in overall net income of 41%, which may sound bad, but 2023 was a really good year for them. They reported earnings after all expenses and taxes of $2 a share, not bad at all. Breaking down where their money comes from, the enclosures segment, which again will soon be called systems protection segment, did just over $1.8 billion in net sales, while electrical and fastening solutions, soon electrical connections, made just under $1.2 billion. A lot of this comes from the infrastructure sector. Looking at their balance sheet, which is a snapshot of what they own and owe, they have a little over $131 million in cash and total debt just over $2 billion. They have liquidity via cash and ability to borrow from credit facilities. They paid out just over $331 million of net income to their owners or shareholders during the year. A key metric they highlight is free cash flow. This is the cash they generate from operations after investments. nVent sees it as a key way of measuring their ability to pay back debt, dividends, and making acquisitions. They are committed to paying dividends to shareholders, which is a great way to keep investors happy. Also, the board authorized the repurchase of additional company stock, indicating confidence in their future. The company also reports that they have distributable reserves, which are required by Irish law because that is where the company is incorporated. They test the value of goodwill and intangibles, which are assets they purchased as part of other acquired companies. This helps them make sure they're not overvaluing their holdings. nVent operates under a detailed framework adhering to US generally accepted accounting practices. This provides the basis for their figures. Now, what does all this mean? nVent is a solid company in an important industry. The trend towards electrification and the need for reliable infrastructure plays right into their strengths. They are making strategic acquisitions to grow and offer customers more solutions. They have a global presence, which also means exposure to global risks. They're managing their debt, paying dividends, and investing in their own stock. All good signs. However, they're also facing challenges. Inflation is eating into their profits. Competition is fierce. Keeping up with rapidly changing technology is a must. On the numbers, nVent looks reasonably valued, based on their earnings and growth potential, with a price-to-earnings ratio of around 20 and an expected increase to infrastructure investment. A reasonable price range for their stock is $75, $85. Overall, I'm leaning slightly bullish on nVent. They have a clear strategy, are in the right markets, and are generating cash. Of course, the risks are real, especially those related to the global economy. Thanks for watching. If you enjoyed this analysis, be sure to subscribe for more corporate deep dives.